What up? It's your boy Cuff, host of the Vision Lab podcast, hanging out with my homie, my ace coon boom, my P. What up, P? Mr. Ryan Mosley. How we doing, sir?
I'm good, sir. I cannot complain. This is the first of a new journey for us.
Yeah, man. I'm super excited because we're doing a brand new special, y'all. The Vision Lab goes behind the dollar, sponsored by Aquila Financial and Tax Services. My man James Aquila. How we doing, man?
Man, fantastic.
Thank you, sir, for stepping up to the plate.
Absolutely.
This is cool.
I like this.
Yeah, this is cool.
Yeah.
So what we did, Visionaries, is we said, look, we produced a lot of content. It's been great. We've enjoyed the ride. It's been absolutely phenomenal. And thank you to each one of our visionaries that tune in each and every week. But what we thought about was, hey, what's a way that we can actually hone in on a specific category, a specific business segment, and really highlight that specific industry. And so we wanted to talk with James today, and for the next 4 months, we'll be talking about financial services in every specific category. And so James has stepped up to the plate with Aquila Financial and Tax Services. He will be sponsoring a brand new series that we're going to be rolling out every month. From
We're calling it Behind the Dollar.
Behind the Dollar.
Yeah, Behind the Dollar. Yeah.
So it's going to be dope, man.
I really like that that series Behind the Dollar because, everything that we do takes finance. It takes funds, right? And so the more aware we are about how it really operates, knowing how money works, man, that just sets you up, financially. It gives you the opportunity to be able to put things in perspective, especially in the very beginning of the year. That's something that's very important to people.
100%.
Hey, how do I get my finances in order, right? And so bringing this, this podcast out, this series out Behind the Dollar, I'm excited, guys. I'm really excited to be here.
Well, I'm glad you said that. So before we get going and jumping into it, this is going to be different from our normal routine of the way we do the podcast. But anybody that is looking for tax services, make sure you holler at our man James.
Let's get it.
He will take care of you. Good dude. We've known him for a while, and I appreciate you stepping up to the plate, man. So make sure you guys holler at James for that. Now, you said something important that I want to go right into, which is it's important to be financially literate, right? Where did your love for, or maybe love's not the right word, but like, where did you become more interested in learning how the dollar works?
Well, I would say this is like I grew up, without any money, right? I grew up in a refugee camp, so that's right there is at the bottom of all of it, right? And so when you grow up, struggling, what happens is as you get older, the main priority is like, okay, well, I don't want to go through that experience again, right? And I don't want my, when I have children, I want to give them the opportunity to be able to step up in life, right? I want to give them a step up in life, but it's hard to be able to achieve that goal if you do not have the basic or the basis understanding of how finances work. Right, financial literacy is one topic that is not taught in school, and so the fact that it's not taught in school, a lot of people wind up in a lot of debt. Just trying to, pursuing either going, into debt with, financial aid, credit card debt. So I started learning very early on. One of the book that I picked up was Rich Dad Poor Dad.
Robert Kiyosaki.
And I brought that book, and it literally, the moment I read that book through and through, it changed my whole concept of how I understood how the dollar worked.
Now, when did you? Because I picked up Kiyosaki. Man, I was mid 30s, 33, 34, 35ish, somewhere in there. When did you pick up Kiyosaki?
I would say it was 2008, 2009. So I was about 23. About 23-ish at that point.
And I think that's a huge advantage, man. And I love the fact that you read, right? Because that's where all the knowledge and wisdom is buried in books.
Absolutely.
And it used to be, you could pass it down from generation to generation to generation. With the disenfranchisement of households, right? You're not seeing that information and that knowledge passed down, that wisdom passed down. So it's oftentimes buried in books. And I love the fact that, you get involved in books like Rich Dad, Poor Dad. So to everyone that's listening, man, if you haven't had an opportunity to read Robert Kiyosaki's Rich Dad Poor Dad. It's an incredible book. He actually parlayed it into an actual game, so it makes it real easy for you to understand. If you have kids, it's a game where you could teach your kids the value of a dollar and money and things like that.
Absolutely.
And he's got different series that he's spun off, right? Like every smart businessman, he's spun it off to some other different things too. So definitely check out that book, man.
It was good.
To piggyback on Cuff's point in regards to reading, right? And like you said, you coming from refugee camp, you didn't want to be in that same place of struggle when you got to be where you had to take care of yourself. I'm sure there are a couple core things that you stand on when it comes to finances. For anybody out there listening or watching or hearing your voice for the first time, you have your own financial and tax services company or business, if you will.
Correct.
What are some of the things that you stand on financially, like your core tenets when it comes to how you handle finances?
Man, that's a good one. Because it's not how much you make; it's really about how much you keep at the end of the day.
Yes, sir.
Right. So that right there, I say a lot of people, they blow as much as they make. And so it don't matter if you make six figure. If you spend six figure, then you're still in the same spot, right? So one of my core, belief is that I always say, I was reading and I also got an opportunity to go to one of Grant Cardon's podcasts or his live, seminar he does. He talks about 40-40-20. Right, he says, save 40% of what you make.
That's aggressive,
right? That's very because save 40% of what you make. Invest 40% back into your business, right, and then live off of the 20. He talks about if your 20 is not enough, then you need to reduce the
what you're living by.
Exactly, reduce your expenses. Reduce, stop trying to over spend. Because what happens is people we buy things we can't afford to impress people that we don't even know.
Say it again.
Right, so we're trying to impress people, but then at the end of the day, guess what though? I would rather have a large bank account than a large house. Right, I would rather drive a Toyota Camry or so than drive, a flashy vehicle and my finances is not in order. What happened was I got into the finance at an early age, really young, and so I was able to go into people's houses, sit down in their kitchen table and do a financial plan for them.
I already know what business you're in.
You know exactly what I'm talking about, right? As soon as you heard kitchen table, you know exactly what I'm talking about.
Kneecap to kneecap.
Yes, sir. Right? And I would say that experience taught me a lot because whenever I would look at somebody's house, I'm like, man, they're really well off. And when it was time I started looking in their finances, I was like, oh no, they in well off debt. They're into a lot of debt. And what happens is you spend the next 20, 30, 40 years of your life paying off debt. And the American dream becomes an American nightmare.
Yeah.
Right? And that is something when I learned that early on. And so I made a decision that was not what I want to have. Because as a foreigners coming here, we truly are seeking the American dream. And so in able to do that, you have to have your finances in order. And you got to live below your means. Right? So those have been, I would say save, be very aggressive. Save 40% of what you make. Right? Invest the other 40 in your business. So if you don't have a business, some of the topic that we'll talk about today is the importance of having a business, right? The book of Robert Kiyosaki, he talks about that the dangerous advice that you can give a child today is go to school, get a good education so you can get a good job. Mm-hmm. Because that advice, though it was a good advice back in the 60s, we no longer live by the 60s rules anymore.
It's at this point in the game now, you're handicapping your kids.
Exactly. And we'll see how that play out when it comes to taxes because everything evolves around the taxes. I feel like the IRS is a mafia, right?
It's the baddest gang out there.
They really are, man. Right? So I would say save. Okay, save 40%. If you're not able to do that, at minimum save 10% of what you make. Yeah. Okay, before you do anything else, before you pay somebody else, pay yourself first.
So I want to break this down because obviously Grant Cardone has way more money than I do, so I can't discredit what he says. That is an ultra aggressive model, right? what I live by, and as a man of faith, you know, my first 10% of every dollar that I get, right, goes back to tithing.
Mm-hmm.
Okay, my next 10%, and this is from Robert Kiyosaki.
Yep.
I actually learned this from him. You know, you pay yourself.
Absolutely.
Right. So 10% goes directly into my pocket. I take the next 10%, right, and I'm putting that into a savings account, and then the last 10% goes either into an investment vehicle or a business that I own.
Absolutely.
Right.
Yep.
So I'm operating off of a 60% threshold. Right. So for those that are in debt right now in the beginning of 2021, you know, it's January. We know that we want to get our mind right. We want to get our bodies right. We want to get our spirits right, and obviously our finances right. Maybe that 40% that you're referencing is too aggressive.
Right.
Maybe the 20% that I referenced is too aggressive.
Yep.
You got to start somewhere.
So we got to start.
What's the tangible? Like, how do we start?
Well, the thing is that how do you run a mile? One step at a time.
Sure.
Right?
Okay.
And so you don't start with the end, and you know, you don't start like, man, okay. You start like, okay, you get a goal. The first thing is you have to establish a game plan, right? Once you establish a game plan, then you come back to, okay, this is the amount that I can afford on a monthly basis.
But you you're already living in a current situation. It's not like you can say, okay, it's now January 2021. I'm gonna go live by this model, and I'm forget all those bills that I've already had. Like you already are upside down on your bills, right? Or
where do you go from there?
Yeah, where do you go? Like, how do you start? And I understand exactly what you're saying.
Right.
It's one step in front of the other, but like the reality of it is help me or help our visionaries, help those that are tuning in.
Yeah.
Like, how do what are some legitimate steps for me to get out? Do I look at paying the highest interest on my credit cards, those bills first? Do I look at paying, those that have the lowest balance? One of the things that we do in my household, and I understand that everybody's not able to do this, I pay all of my, what I call my stationary bills up front. And like I just paid them, right?
Yep.
So, I don't pay my mortgage up front in case I want to sell my house, and I don't pay my electricity. But everything else, my cell phone, gas, electric, you name it, anything like that, cable bill, all that stuff gets paid up front. I just drop a check for each one of those, and I
Pay them off.
I work it off. But for somebody that's looking to
Take the initial step.
take that initial step, what is a tangible step or advice that you can give them?
Okay. So I'll put it this way, okay? If you are currently making decision based on your current circumstance, right? What you are doing is you're making a decision to stay in your current circumstance. So first, the biggest issue that keeps people in the same state that they're in is lack of income. Okay, that's the biggest one.
Sure.
Right? Because if you had additional income, well, of course, you can be able to save that to an additional, because now that's additional income that's coming in. You can save 10%, you can save 20%, or whatever the case is. So in most people, and then this was a struggle that I, in the early on, whenever I was doing the financial planning, is that I would sit down with someone and we can put a plan together. So, okay, hey, first thing first, let's do a snowballing effect. Okay, let's pay one credit card off, take the same amount of income, the same amount of dollars that you were paying for that, and then add it to the next one.
Promoted by Susie Orman.
Susie Orman, Dave Ramsey, they utilize. And that's a great concept, it really works, right? But the issue is that, okay, what happens if all of a sudden your tire blows out? That plan goes right out the gate, right out the door. So what I find is that making additional income is going to be the biggest boost to your finance, and that will help your plan, start in place. Now, so let's say, for example, we're going to build a financial house. What is the proper steps? Okay, and now we got a whiteboard for visualization, and let's put it together. Okay,
Come on. Solid foundation. Obviously, we're building a house. So we want a solid foundation.
There you go. See, now you're talking about a house. So let's talk about that real quick. So if you are, let's say, in the beginning of the year, we want to establish a plan. What do we need to do? Well, what's the most important thing when it comes down to building a house?
Solid foundation.
Okay. So now, what I'm gonna ask you guys though is, don't judge my house. It may be,
right, you're good.
It may be a hut, by the time, when we finish, but it's gonna
As long
be.
as it keep it warm at night and protected, you're good.
Absolutely. Right? So having a good foundation in place is good. Now I'm gonna go ahead and put this in, and then we can come back and play. Right? So a foundation for every family out there. The first thing first is the breadwinner and the mom and dad. Let's say we have both spouses at home. If one of them were to pass, okay, it will put a complete financial devastation to the household. And that is what happens a lot of time, is not having, life insurance in place is going to cause a financial devastation. So the first step is say, okay, hey, how do we get out of the scenario that we're in? This is our circumstance. How do we get out? First thing first, you got to have insurance in place. Okay. Now, the reason why I start here, like I said before, we have no idea how much time we have on this planet, right? But if you have children, you have anybody that's relying on that income that's coming in, you need to make sure that you have an insurance in place, just in case, God forbid, something happens. Hey, that's an additional $150,000, $200,000, $500,000, $800, $1 million that now just comes in as a replacement of you. Now, once again, there's nothing that can ever replace a person. Mm-hmm. But financially, though, you can make sure your family continues to go on, right? So this would be the number one area if we were to say, okay, how do we get from point A to point B to point C and so forth? Right. Making sure we have the proper life insurance.
And real quickly, I know a lot of people that are watching or that are listening are saying, man, look, I don't believe in that. It's just another scam. Insurance is a scam, so on and so forth.
Until you need it.
It's required. Mm-hmm. And here's why. You were born to die. Everybody. Period. Yep. Point blank, right? There's not a person that's been born that hasn't died.
Absolutely.
Okay? And whether your premium is $30 or $300 a month, mm-hmm. you need to take care of your family. Even now, I want to challenge this to you. Because what you're talking about, I know where you're going. It's term life insurance.
Term? I was just insurance.
Any type of insurance.
Just have something.
Right.
Have something. So what if I'm 20 years old, mm-hmm. no kids, I'm not married. Do I need this?
Do you need this? So you don't have no responsibility as far as, somebody that's,
if someone. I don't have any dependents.
Okay. Now, here's the thing. Will it cost money to bury you?
Yeah.
So where's that money gonna come from?
My savings.
Do you have enough to cover?
What's the average cost of a funeral? You got to ask yourself these type of questions.
About 10 to 15,000. Yeah. That's the average. So if you have 15 to 20,000 in your account, then you're self-insured at that point. Okay. So is that necessary? No, it would not be necessary.
But if I don't have the 10,
but if you don't. Right, because what insurance is you buying money that you don't currently have. Mm-hmm. That's all it is. Because, it has to come a time where you have enough set aside you have enough investments, you have enough saving to be able to be self-insured. But until you are self-insured, you need to purchase the fund. You need to buy the money that you don't currently have.
And I wanted you to clear that up because insurance should be used in the event that you don't have enough to cover, right?
Right.
If you've got $10 million, right? And your lifestyle is suggestive of $500,000 a year,
right?
You're good.
You're self-insured.
You're self-insured.
I mean, if something happened, guess what? There's enough funds there to take care of you and your estate and your family.
But by and large, most people are not self-insured.
They're not in that scenario.
Okay.
Right? So insurance is only to be is a security when you don't have it.
Yeah.
Right? If you have it, listen. There's no need for it at that point, and it becomes more of a want. Say, hey, why not? Let's add an additional to what I currently have. At that point, right? Now, once you have this in place, the second step, we gotta go into consider getting out of debt. Okay, consider getting out of debt because having too much debt is going to constantly keep you crippled. Okay, so you have to figure out a game plan to get out of debt, and this is where the snowballing effect that we were talking about earlier come in. To put all your, put all your, your credit cards together, your debt together, and come up with a game plan and see exactly what's happening.
So, would you recommend someone that has, let's just say, 5 credit cards, consolidating those credit cards and doing balance transfers to bring them all into one
Get
spot?
everything into one.
Will they increase? It depends. Will they reduce the amount of interest rate on when if they consolidate all of them?
Yeah,
I would hope so.
Yeah,
we call those credit card companies and say,
Exactly.
look, will you absorb the rest of my debt and I'll just pay you?
Yeah,
Right.
Especially with all the different promotions that are out there where you can get 0% APR for 18, 24 months or whatever that is,
Yeah.
right? Like, would that be a strategy to bring all of those 5 credit cards into one?
You can do that. You could do that's one strategy. Another strategy is if you want to keep them where they are, and let's say for example you owe Capital One, $500, right? And then you're able to go ahead and pay off that, to Capital One. Now you freed up $500 from there. Let's say the minimum payment, I'm gonna just say throw $50 a month.
Sure.
Now that's kind of high, but let's say it was that. Now you have an additional $50 per month that you're able to add onto your city credit card.
Not to go buy new clothes or anything else.
Thank you. I'm so glad that because that is what happens. Somebody be like, oh, I just paid off my Capital One. I have free $50 a month. No, you don't have a free $50.
Take that $50 to something else, please.
Exactly. Right? That 50 is it has a responsibility to another spot, because when you have your budget and you said, okay, every single month I have $2,000 that's going toward debt. Okay, that now 50 is freed up. You still, that responsibility is still there. $2,000 is going out for debt. So now you take that 50, you add it to the city credit card. Now let's say the city credit card was $150 a month. Now you have an additional 50. Now you're sending them $200 instead of $150. Okay, that shortens the amount of time that you actually owe the debt with them, and you're able to pay that off, and you freed up the $150. Now you got $50 that you freed up from the first time. You got another $150. Now you have $200. Once again, guess what we do? We take that same $200, add it to the other credit card number 3, and you just keep repeating that process until you get out of debt. See, here's the thing: getting out of debt is not the issue. A lot of people have got out of debt. It's staying out of debt is what keeps people financially broke. Because you can go out there. A lot of people use their refund checks, right? They'll get $5,000. They'll take the full amount, put it toward debt. Now here's what happened: they took funds that they had. Okay, if they used it properly, they would have stayed. They would have stayed out of debt. But the issue is most people do not have an emergency fund at all. Okay, most people don't have. So let's put this. So debt elimination, right? Put it emergency fund. Probably should put them backward. I'm African, so how do
G. Yeah, there you go.
Emergency.
There you go.
There was that. All right. So actually, I will flip them. I will flip this too. Okay. So I would actually focus on establishing an emergency fund. As soon as you have a life insurance in place, establish an emergency fund, because then work on getting out of debt.
Now,
okay?
you have Dave Ramsey theory, right? Mm-hmm. He says you need to have $1,000 for an emergency fund.
Okay.
What say you, sir?
I would say you need to have at least 6 months of your
income.
So you call that an emergency fund?
I would call it an emergency fund. Because here's the thing though, if you lose your job, it takes time to be able to actually find the next one, right? Go, the whole job interview, all of those cost money. So what I would say the ideal plan should be is to have an emergency fund of at least 6 months in place. So now you can start building that. You can start with 1,000 and say, hey, first goal, let's get to 1,000. And then from there, let's establish a plan. what does our 6-month budget look like, or our 6-month emergency fund looks like.
Now watch this. This is what I love about what we're doing here, right? So if you take the Grant Cardone theory and apply that to the Dave Ramsey theory, your 6 months should only be a 20% of your income, right? So if you reduce your bills, right, to a 20% threshold or figure, it shouldn't take you so long, right? So let's just say, to put things into practical purposes, right? Let's just say that your bills total $2,000 a month, right?
Yep.
If you're looking at an emergency fund of 6 months, that's 12 grand.
Yep.
Right? That's something that's achievable. It's not
Absolutely.
$70,000, right? Or 50,000 or anything like that. It's 12 grand. So I love what you're saying. If you and I think that's the beauty about what you're saying, right? Like you can combine different philosophies and theories and make it apply to your life.
Right. Because the thing is that everybody life does not all operate the same way.
Right.
So find a plan that works for you and implement it. The problem with most people is that we constantly jump from one to the other. You know, and hey, this is not working, so we jump to the other one. That's not working, so we jump to the next. I'm like, listen, if you allow time to run its course, you will actually build something worth of value, right? You actually build it. So just the same thing as emergency fund. A lot of time people, they put money in and they take it right out. No. That's not an emergency fund, right? So as we talked earlier, right? When you're building a house, you got to have the right foundation set in place. You got to build it one brick at a time. Take your time and establish a plan, you know, because a lot of time, when we did the research back a couple years back, we find that most people at the age of 65 are broke and still working. In the wealthiest country in the world, because let me put it this way: if you make $30,000 a year, you are in the top 10% of the whole entire world when it comes to income. 30,000, right? And so some of our speakers, you know, will be listening to, you know, you might make 30,000, and you are already in the top 10% of the whole entire world. But what happens a lot of times, especially here in the U.S., is that we fail to plan, right? We fail to plan, and so we think that we're gonna have more time. We think that, okay, if I just skip today, right, I'll do it tomorrow. Procrastination is the price that we pay, you know, for the vision or for the goals that we chose not to actually accomplish or to go for. And so if we looked in that, you know, earlier you asked me a really important question, like what, you know, what's the driving force, or
What do you stand on?
you know, what I stand. Well, my thing is, by the time I'm 65, okay, I want to have. I always say that my financial goal was about $65 million, right? Now, once again, they say dream big. It costs you absolutely nothing to dream big, but it costs you everything to dream small. So if you're always dreaming small, if you're always thinking, okay, well, listen, you know, I can't do this, or I can't, and the reason why it's not happening is because you are telling yourself you can't. And the moment you say you can't, you're right. You know, they say he that says he can and he that say they can't, they're both right. They're both right.
Yep.
Right? So building, you know, having the right foundations in place, these are, you know, baby steps that every single person can take to build their financial house. Starting in January, and I don't even say start in January, start as soon as you can.
Start as soon as you watch this podcast.
Yes.
Or as soon as you hear this podcast.
As soon as you hear it, go ahead and start your plan.
Yeah.
Right?
To push the ball forward, James runs a financial and tax services. We are at the time of the year where you are obviously very, very, very busy.
Yep.
Taxes.
Well, hold on. Let him finish the house.
Finish it? Okay, well, let's finish the house before we move to taxes.
So let's finish the house real quick. And then how taxes come into all of this, right? So have your life insurance, establish an emergency fund, start a debt elimination process to get yourself out of debt. And then at that point, you can start thinking about retirement. You can start thinking about setting college plans for, for your kids, etc. Right? So this is where you can start dreaming as far as setting things that you've always wanted for your kids. Because once again, I would not be thinking about a college plan if you don't have any life insurance in place. That's like building a house on a sand, right?
Okay.
So let's establish that in place. Let's have an emergency fund so that way you don't have to keep getting back into debt, once something happens. Because this is your debt proof right here. Your emergency fund is your debt proof, plan. And once you start eliminating debt, you are able to stay out of it. Then at this point, of course, you have college plans, retirement. You can set up IRAs. And let's push the college plan a little bit higher. IRAs, okay? Individual retirement accounts. So you have traditionals and you have Roth. You also have your traditional 401k at work that you can use. Okay, so these are different, plans that you can be involved in to start establishing yourself financially for the future. Because it's not a matter of when you're gonna, if you're gonna get old. It's a matter of when, right? And so the sooner you set a plan in place, time is either working in your favor or is working against you. Because if you establish an IRA when you were 25, 20 years old, imagine what the balance would be by the time you're 65.
It'd be beautiful.
It would be very beautiful. And you can actually enjoy your retirement. Now, here's the thing. I really don't like the word retirement because I don't intend to ever retire, right? And the reason being is, you have to build a life that you do not need a vacation from, right? You have to build a life. We're here. We only have one life that we have. So my thing is that if we only here one time, why not make that one time a masterpiece?
Wow.
Make it a masterpiece. You don't have another time to rebuild, to come back and play it again. It's like, no, this is all we have. People always says that we only live once. No, we don't. We die once. We live every single day. We live, we die once.
Woo! James got the proverb.
Man, some African proverbs there.
Right? We live every day. And so therefore, these right here allows you to be able to live life more on your term when you set this in place. Okay? Buying the watches, buying the Roy's, getting all the flashy, things in life. Those are all great. I'm all for it. When your pocketbook,
When everything is in order.
when everything is in order.
Jay-Z said, if you can't buy it twice, you don't need to buy
You
it.
don't need it. You don't need it. Now, if you want it, here's the thing. Here's the power of want. If you want something bad enough, you can have it. Okay? But don't sacrifice your future for your gratification right now. And that's what people do. They borrow from their future using debt, right? For right now. So if you cannot afford it right at this moment, then work to get it. Right?
So we've got our life insurance.
Yep.
We've got our emergency fund
Yep.
set up. Whether it's $1,000 to 6 months, you've eliminated your debt. You're now at the place in the time where you can start to save for retirement,
Yep.
even though you don't like that word. How much should we be putting into our retirement funds? Because earlier we talked about using Grant Cardone at that 40%, which is, again, I'm not. It's hyper aggressive. I'm not suggesting that, but you surely will get to wherever you want to go at a 40% of every dollar,
Yes, you
right?
will.
But just starting off, what should we allocate towards retirement accounts?
Well, I would say this, right? You have, you start with the end in mind. Just like we started earlier, how do you run a mile? One step at a time. But you've already determined in your head, in your mind, we're running a mile, right? So it's not we're here, it's like, how long you gonna run today? Well, I don't know. We're just gonna run. No, we know, hey, we're running a mile, right? So that's the same thing I would say is establish with the end. If you were, let's say, for example, at this point, you're age 65, you're about to retire. Now the question is, how much do I want in my portfolio? How much money do I want in my investment account, in my 401k? And we said, okay, well, listen, for me to be able to do the things that I want at the age of 65, to retire and live comfortably, I need $500,000. I need $1 million.
Is that annually or is that in totality?
In totality, I need $1 million to be able to live comfortably. Okay, now we have a plan. Now we have a goal that we need to achieve, and then we work our way backward based on how much time we have, and as well as how much resources we have at the moment to achieve that. Okay, and so let's say you have 20 years or you have 30 years. And it requires that you put in $500 a month into your IRAs or into your Roth. If that's what it needs, if that's what's necessary, then that's where we start. Okay? So every single person's scenario is going to be different based on their vision, based on their plan as far as how what they need to have, and then we work our way back. Okay? But you have to have an IRA. You need a Roth or a 401k or whatever.
And one thing I want to stress is you have to treat this like a bill.
Oh yeah, absolutely.
You have to treat this like a mortgage.
Absolutely.
Because that's one of and the funny that I say the word mortgage, because you're mortgaging your future. If you don't, you're mortgaging your future if you're not treating this like a monthly bill.
Better hit the lotto and have one heck of a business plan if you ain't got one.
Say hit the lotto.
Hit the lotto. If you're not, I mean, Coach, right? Like if you're not. And if you don't have something along that part of the house, an IRA or whatever version of an IRA or 401k, the term mortgaging your future is perfect for it. Like you're looking at being a Walmart greeter in your older days, and you're going to literally be check because by the time we were 65 years old, Social Security and all that stuff
it's gone.
It'll be a relic.
Yep.
We're in an age now where companies are not giving people pensions for working for 30, 40 years for the city of XYZ. Like, those days are over with. So, unless you hit the lottery or you got one heck of a business plan that's going to sustain you at that part of your life, you have to have something along those lines of a 401k.
Absolutely.
You got to.
Now, here's the thing, right? You need to be in control. More than anything, people need to be more in control of, where these assets are. The IRA, the Roth, or the 401k, you need to be more in control of it, because what happens is a lot of time people put this responsibilities on companies. Hey, I'm putting money in my 401k at work, right? Well, how much is it? Do you know how much you need by the time you retire?
What fees are you paying?
Exactly. What fees? So you need to be more in control of what's happening with your finances, because only you know how much money you need. Only you know exactly what your visions and goals are. So the more proactive you are about your finances, the better it's going to be, right?
The word that constantly keeps springing up in my mind as you talk, and this has been outstanding, is it's being intentional. It is intentionality.
That's it.
It's saying, listen, I think a lot of times people don't want to recognize that you're born, like I said before, you're born to die. You don't know if that's going to be, you're born at 0, right? You don't know if that number is going to be 18, 45, 65, 95, 105. You don't know.
Right.
But you do know it's going to happen. So work it. I love what you said earlier about working it backwards. And everything that we've talked about thus far are things that we can control.
Exactly.
We can control the expenses. We can control the willing or the wants in our lives. I may want to buy a Bugatti, right?
Yep.
Whether I may want to buy a Bugatti.
Why not?
Yeah. But if whether I can afford it or not, is that the best decision to help me reach the goals? And I love how you keep dropping the word vision. Shout out to the Vision Lab.
Hello.
But does that help me reach that vision? And the other word that constantly springs to my mind as you're talking is the word discipline.
That's it.
And that's what we often lack, right? It's not a matter of not having enough. We just make poor decisions with what we have.
Yeah.
So and we're getting ready to go into February. So hopefully you guys have gotten your mind right. Hopefully you're getting your spirit right. Hopefully you're getting your body right. And then the last component of that is the financial aspect of that.
Absolutely. Let's get your pockets right.
Let's get our pockets right in 2021. 2020 was a bitch. It was a monster for a lot of people, right? I had a good 2020 until the second half, and it wasn't as great as I wanted it to be, and that's okay, right? But we're still here, right?
Absolutely.
So let's leverage this, and let's have a plan. Let's be intentional
That's it.
about what we're doing.
The hardest thing to do is to coast uphill.
Say it again.
The hardest thing to
That
do.
gum African proverb, man.
Full of them. Visionaries like Cuff and I obviously have known James for a while now, and you're kind of getting a look behind the curtain, if you will. I know this is behind the dollar, but you're getting a look behind the curtain of some of the sayings and proverbs that he comes up with. But if you're really paying attention, they make all the sense in the world. And, that is a gem.
It's hard to coast uphill.
That is a gem.
Behind the dollar, y'all. Let's
Yeah,
go.
This is why we were doing this particular part of a spinoff, whatever you want to call it. Again,
Series.
A series. Yeah, this is the first episode of its nature, if you will. But behind the dollar, this is what we're gonna have more of these conversations, and this is what we are trying to educate you guys about. Like Cuff and I don't know everything about finances, but you will see in the coming weeks we're going to do everything we can to help you guys when it comes to financial education.
Absolutely.
And if you're not already, make sure you're following the Vision Lab podcast on YouTube. If you like the content that you've heard thus far, go ahead and smash that like button and make sure you hit that subscribe button as well.
Let's get it. All right. So as we finish our house here, right? Of course, we have our foundation, we have our walls. Of course, we gotta make sure we have a roof on top of this.
Absolutely.
Right? So the roof, of course, this is where the Bugatti comes into play, right?
See,
I have to give him his Bugatti. Okay, we gotta put the Bugattis in here. All right. So,
we're not judging your art skills. You're good. Don't even worry about
You're
it.
a terrible artist.
Don't even worry about it. We'll have an inspector.
really
We'll have an
bad.
inspector out before we actually finish off the house and let you live in there.
Telling you,
I can't even flip this house.
not put this out at all, right? So the roof of this, right? This is where the college plans comes into play. Okay, the college funds, the vacation home, right? Vacation. The cars. I mean, anything that you want.
This is your dreamer's
This is your
paradise.
dreams. This is what you've always wanted to achieve and stuff. But you gotta have the right foundation in place and able for you to reach your goals. Because what happens is too many times people want to just get to their dream. They want the cars. They want the vacation homes. They start with the college funds. Here's the thing about the college funds, right? When you're 65, your kids will probably be in their 20s, 30s, etc. They are able to take care of themselves. Okay, they can take care of themselves. Now, yes, it's a good fun. It's good to have something that you can give to them. So because the less debt that you can help them stay out of, the better you're helping their financial future. Okay, but at 65, what you cannot do is reverse time. You cannot reverse time. That's why it's up here as far as the goals and visions, and right, it's up there because if you didn't take care of this parts right here are not coming into play. So having having these in place definitely allows you to make sure that the foundations are established. Everything is where it needs to be. One of the I was listening to TD Jakes one time, and he talks about our culture. He says the issue with our culture is that majority of the time when our parents passes, our grandparents passes, they leave debt instead of inheritance, right? Instead of assets for us to be able to get that step up. So if the next generation is always constantly having to start over from scratch, it's hard to get ahead financially. It's hard to build that generational
stuck in neutral
that we talk about, right? And so how do you set those in motion? Well, guess what? Having insurance to take care of yourself. Establishing emergency fund to take care of making sure, hey, it's not if it's going to rain, it's when it's going to rain. And then when it does, hey, we already had a plan in place for it.
Yeah.
We're ready. Being proactive instead of reactive.
Yes, sir.
Right? Debt elimination, getting that out of the way. Now, guess what? Once you eliminate your debt, let's say you had $2,000 that was going toward debt. Now you have $2,000 that you can fully fund your Roth IRA, your traditional IRA.
And I'm glad you said that because you're still using your $2,000,
Exactly.
right? But this is now going to fund a different fund, right?
Exactly.
A different part of your house.
Exactly. Right? And so all of that is still staying within the budget, staying within what you currently have. Now, once again, one of the best way to boost everything is having, either getting another job or starting starting a business to produce that additional income into the family. Because if you are capped, let's say you're bringing in 5,000, 6,000, 7,000 a month in, and you're already capped at that point, you need a boost. Okay, you're going to need a boost to be able to get there faster. So this plan works within the budget that you have in place, but it's always even more beneficial. It works in your favor if you're able to add an additional income that can help you get there faster, right? So this is right here. If we were to say, okay, look, it's January 1, what should I be doing? Where do I need to start? I want you to picture a house and now put that in your mind. Okay, what's the most important part? The foundation, okay? So in your finances, what's the most important part? Having the insurance in place. If you don't have it, then that's what you need to do. That's the first thing that you need to do. Then establish your emergency fund. Let's get that in place. Then get out of debt. Then start building your Roth IRA, traditional IRAs, and then let's get the kids into college. Right?
So I absolutely love everything that you talked about, that you showed up here on the whiteboard. I want to challenge you with, I'm 45 years old.
Okay.
I've been working for the last 25, 30, 35 years. I'm in debt. I've got 3 kids, 2 kids, whatever. Is it too late?
It's never too late.
Okay. How do I get out? Real quickly, how do I get out? Because that's what people want to know, right? Like, how do I get out?
Real life has happened. Like,
I've
had to do what I've had to do to get to this point. So
right.
now what? This is what I'm stuck with.
So your 20-year-olds, if you guys aren't eating this up, shame on you. Because with the emergence of the internet, YouTube, and podcasts and everything else that's out there, like, the information is there, right? Whether your parents know it or not. But to our older generation that still have, like, we'll call it 15, 20 years of their working life, if not longer.
Right.
Like, how do we help them? How do we say, I don't care that you're $10,000, $15,000 in debt, that you've got 2 kids that are, within 5 to 10 years of college, right? How do we help them? Real quickly, how do we serve them?
Here's what I would say, okay? There is nobody that is coming to save you. Okay? The reason why I say that is the moment we understand that all of this is our responsibility.
Sure.
Right? That it's all 100% our responsibility and there's nobody that's coming to save us. At that moment, it will create a sense of urgency that you got to do what you got to do to get there. So you're 45 years old, you got 15 years before retirement gets here. What do you do at that point? The fact is you're now aware. Awareness is the biggest thing that you need to, right?
Okay.
You're now aware. Okay, same process. Everything still applies. You still, do you have responsibility? Do you have anybody that's depending on your income at this moment?
Absolutely.
Same process. Okay, you have debt. Guess what? We got to get into that. Once again, the simplest and the fastest way is you have to make more money. That's the hardest thing. That one key right there is because of how everything has been set. Back in the 90s or early 1800, late 1800, I would say 90% of people own their own business, and only 10% work for somebody else. And then fast forward 100 years, 90% of people work for somebody else, and 10% own their own business.
Yeah. Well, next week we'll get into that.
Yeah.
We got some really cool dudes that are jumping into the lab as we go behind the dollar, and they're going to show some different ways and creative ways that maybe you may not have been aware of, right?
You can actually start making some more money.
Right.
Yep.
I want to now shift into taxes.
Okay.
Because that's where you make your claim to fame, right?
That's it. Yeah.
All right. So let's talk about taxes.
Your wheelhouse.
Your wheelhouse. But here's the deal. We did a great job of giving the foundation on the house, right? And that's basically keeping your money, like saving it, right?
Absolutely.
There's income, which we really didn't talk about, other than, if you're at a deficit, you need to get an additional job to cover that, right? So you got income, you got, what you kept, savings, you can call that planning for the future. But the most important element in terms of keeping your money are taxes.
Yep,
And
absolutely.
that's where you shine.
That's where I
So
come in.
let's get into that. And by the way, this episode is sponsored by Aquila Financial and Tax Services. Again, if you're looking for any type of financial advice, holler at our man James.
Absolutely. So, I would say I've been in the tax business for about 8 years altogether now, right? So it came to me because I did not understand how the tax world worked. Like most people, we're not taught how the tax game work. Okay, so we all been taught go to school, get a good education, so you can get a good job. What that turns into, you paying your taxes basically. So I realized that there are two sides to this coin. Okay, there are those people who earn money, pay taxes, and then save what's left over, right? And then I found out there's a whole other side, which is you earn the money, you spend, and then you pay taxes on what's left over. And I wanted to be on the other side, on the second part, because if I'm paying taxes on what's left over, guess what I get to do? Make sure there's nothing left over.
Right.
It's simple as that, right? But to get to that part, a lot of time I have to take my clients to the basis of how the tax industry really work. How does the IRS, the government, gets to determine what is it that you get to pay when it comes down to the money that you make, right? And so the simplest way I can do that is by putting it on the board, give you guys a visualization to make it work. And I like to call this session Taxes 101, right?
Taxes 101.
Taxes 101. If we're gonna go to school, we gotta go and learn the basis of this, right? So Taxes 101. How does all of this come together to determine how much taxes that you actually make or that you pay at the end of the day, or if you're getting a refund back? Because especially during this time of the year, from January to April, that's the number one topic on everybody's mind. Okay, and the funniest thing is that most of my clients that actually owe, they're always pushing for extension. Comes April 15, they're like, listen, you already know what to do. Okay, push that button. we're not ready to send that check right now, right?
And real quickly, and you may cover this, I don't know.
Absolutely.
A lot for those people that are getting tax refunds. That's a no-no. That's a big misnomer. You should not be getting a tax refund.
Now, it really depends on their circumstances.
Okay.
Right? So I'll break down to, it depends on their circumstances. Because there are some people that is just going to be what it is. It is what it is. Right? Now, once you start getting to a certain criteria of income, right, that you're earning a year, now tax planning is a major factor into making sure that either you're breaking, even with the IRS, or you're paying as little as possible. Right? So when it comes down to it, now, let's go back to the drawing board and try to do a better job.
I'm scared. Here we go.
I'm scared too, okay? I'm scared as well. Let's see what we got here, okay? So the simplest way that I can explain this to you guys is drawing this octagon. Let's see if it works. Okay.
Yes, an octagon. You got it right.
This is gonna be this is as best it's gonna get. Okay, that's it, right? So when it comes to taxes, the basis of taxes all starts with income. Okay, if you don't make any income, this does not apply to you at all because they cannot tax you on money that you did not earn. Right. So the first step is income, and the max that you can make per year without you having to start paying taxes is about $12,400 this year. Okay, 12,400 is basically the most that you can make without having to file your taxes.
Now, is that 2020's numbers or
that's
2020? Okay,
that's 2020's number. Yes, right. So income is the basis of all taxes. Now, once you have your income, then we go to to what I call adjustments. Okay. Now, the areas of adjustment, this is where if you're a school teacher, you can actually take about up to $250 a year off of your income as an adjustment. Okay, so that just means if you made $40,000, you can take $250 off of that and reduce your income. So adjustments. Now, what I'm going to do is give you guys an overview because if we go into each of these area is a whole different tax world itself. Right? And so once you have your income, you have your adjustments. That's going to produce what we call an AGI. An AGI stands for adjusted gross income. So as you can see, income, after you adjust it, that's your AGI. Make sense so far?
Yep.
Right? And then from that point, this is where you take what we call the standard deduction. Okay? Standard, and you also have the option of itemizing as well. Now, you have a choice. You can either take the standard or you can take the itemized. So it depends on how much money you actually spend in tax, property tax, mortgage interest, gift to charity. If you're single and you have a mortgage and etc., the itemizing might be the best route to go. Reason why? Because as the standard deduction for a single person is $12,400. Okay. Now, in that scenario, if your property taxes and mortgage interest is more than that, then you just go with that number.
It's interesting that your standard deduction is $12,400 and your income on the lowest level is $12,400.
Do you see what we just did there?
Yeah.
All right. So the standard deduction is what the government give you to say, hey, listen, we are going to take off. If you're single, we're going to take off $12,400 off of the money that you make, and then anything beyond that is what we're going to start taxing you on. So if you're single and you just made $12,400 or $12,000 total, there's no reason, like we can't tax you because we already give you the standard automatic. So now, once this happens, so as you guys can see, this is the journey that your money is going through. Okay, you make the money, you get your adjustments, you get your AGI. Now AGI is very important. I'm gonna come back to this point here shortly. And then now from that point, you're gonna take what's called your standard deduction or itemized. From this point, that's going to determine what is your taxable income is. Okay? Now, whatever number this is, that is going to determine what your tax rate is. That's going to determine what you're paying taxes on. You're not paying taxes on the income that you originally earned. You're paying taxes on your taxable income. Mm-hmm. Okay? From this point, now we have what is called our tax bracket. Okay, of course we have the 10%, the 12, the 22, the 24, and etc. So at this point, most people fall into the 12 and the 22% tax bracket. If you make it between 25 to 80,000, that's where you're going to fall into. Okay, so and then at this point, once we determine what your tax bill is. Now we have to determine how much did you pay in on your W-2 when you are earning your money, right? So you have your payments and credits. So the credits are basically, if you have children, you have the child tax credit, right? So this is all the different credit that's going to reduce your tax bill. So, the American Opportunity Credit for going to school, the child tax credit for having kids under the age of 17, right? The foreign credit, we have the residential. There's a list of credits that goes here. So what happens is you add these two together, and now you're going to have what's called, you get either a refund or
a bill.
Exactly, right? So when it comes down to it, now we got to fill this part right here, which is before you start going through this cycle, you have to determine what is going to be your filing status. We have married filing jointly. We have qualified widow with a dependent. Okay. We also have head of household. We have single. We have married, filing separate. Now I have them in order from the best to the worst. Right? From the best filing status to the worst filing status out there. So as you guys can see, so if you were married filing jointly, it pretty much double the standard deduction. Right? So you put your income together, you take off $24,000, automatically, okay, from your income, okay, and then qualified widow is the same. You still get the same $24,600 that goes with it. So what that does is the qualified widow is someone who have a spouse who died in the year, okay. So let's say for Sue and John, they're married in 2020. John dies, okay. 2020 tax year. They still file married filing jointly. 2021, Sue, she has a 7-year-old child. So at this point, she gets to have the qualified widow with the dependent. for the next 2 years after the death of the spouse, right? And then head of household. This filing status, you have to at least taking care of the bills more than 50%. Of your dependent, you have to have taken care of them more than 50% of the time throughout the year. So that means paying all of the expenses more than 6 months out of the year.
Let me ask you a question.
Mm-hmm.
Whether it's the husband, wife, husband, wife, how whatever your breakdown is.
Right.
Head of household is, let's say I make the most money in the house.
Right.
Right.
Mm-hmm.
Does that make me head of household?
See, that's the misconception that most people get.
There you go.
That's
Yes.
a lot of people think, okay, hey, listen, I make the bread in the house, so therefore I'm the head of household. Okay? No. The head of household filing status really depends on if you have a dependent. That's all it boils down to. Having somebody that you took care of.
Whether you're married or
Well,
you have to be
you
married.
have to be head of household means somebody who's unmarried that has a dependent. Because if you're married, you just automatically have the married filing jointly status. Because now there's two of you guys putting together, and you're dependent. The head of household is you have to have either one live separate from your spouse for more than 6 months of the year, or never been married before and you took care of the child or the dependent for more than 6 months.
Do you have to have? Because I know divorce is real, right? And child support and custody and all that stuff is real.
Right.
Alimony.
Alimony,
Yep,
all
all
that
of
stuff.
those are placed.
So do you have to have child support to get head of household?
Do you have to have child support? Well, here's the thing. Child support is neither income or a deduction to the person that pays it. Okay? So if you're receiving child support, it got nothing to do with taxes. Okay? So no, you do not have to receive child support to be able to claim. As long as you have a dependent that you are taking care of for more than 6 months a year, you qualify for the federal household.
Can you, if you're a non-custodial parent, right, and you pay child support, but the child doesn't live with you, can you file can you keep them as a dependent?
Can you keep who? The child?
The child.
No. So if the child is not living with you, then whoever the child living with is the person who gets to claim.
Clears the claim dependency.
I just wanted to clear that up. Sorry for those that are dealing with that, but you got to know.
You got to know, right? Now, let's say, for example, in that scenario, the custodian parent say, hey, you can claim them. Because you do have the same right. They are your blood, right? They are your child. You can be able to claim them, but you have to sign some documents to make sure that you were given the permission to be able to claim that, you're dependent, okay? But just because you're the one that's making most of the money in the household does not qualify you as a head of household, okay? And now, in the scenario, they can be a scenario where only one spouse is working in the house, and you can still file married filing jointly. As a matter of fact, it actually works in your benefit to do that. Okay, so those are the filings: married filing jointly, qualified widow, head of household, single. Now we don't have to go into too much detail with single. You're single out there mingling. Okay, there's nothing else you can do. There's nothing else to do. And then of course we have married filing separate. In this scenario, there are cases where both spouses chooses to take their own responsibility of their tax liability to themselves. They may actually make too much to the point where if they combine the income, the tax bill is going to be substantially higher.
Now,
so they choose.
You become ineligible for those deductions.
Right. So now, here's what happens on the married filing separate. You lose a lot of credit by filing married filing separate. You lose a lot of credit. It's actually not a favorable position or filing status to be in. Now, but the reason why the IRS chooses to do that is say, hey, listen, if you guys make too much money and you chose to file separately, there's no reason for us to give you any credits because you can take care of it, right? You got that under control. So that's another area. Another reason why people would choose to file married filing separate is, let's assume the wife has student loans and the husband does not. If they file together, their refund is going to be offset because of her student loans. So they may choose to file married filing separate. But if you work with a good tax professional, they can show you how you can actually still file together using different forms that the IRS provide to be able to still file married filing jointly, even if the spouse owns either child support, student loans, or back taxes, and you can still be able to qualify for a higher favorable tax position instead of sacrificing all your deductions or and credits, right? So this right here is a general idea of how behind the dollar that your money is being taxed, right? So when you earn it, now how you make your money does have a major factor in how you also get taxed. Does that make sense?
Yeah.
Right? Because if you're a W-2, guess what? And that is all you have. You go from income straight to AGI, and that is it. There's no adjustment. You don't have any you don't have no deduction that goes along with it. It goes straight there. And so now at this point, you are paying the highest in taxes. There's a saying that I tell all my clients: the people that pay the most in taxes are the uninformed. So don't get mad. Get informed. Okay,
That's
right?
good.
So I know that people are like, "Hey, Trump only paid $750 on his taxes. How is that possible?" He's well informed. He got people who are well informed as far as how the tax code works. Okay, so this right here. So questions about what we have put as far as this is a general idea. General how to get understand how the tax work. Where are you? How are you getting taxed on your money overall together? So any questions on it?
No, I'm good, but I do want to get into, we just rolled into W-2,
Mm-hmm.
right?
Correct.
How to actually fill out your W-4,
Mm-hmm.
which is the most important thing, because that ultimately
Determines
what
what your
payments are or your credits.
Exactly.
So this is a great illustration. So all visionaries that are tuning in on YouTube, make sure you write this down so that you have a really good understanding. But I want to fast forward and move into how we actually fill out the W-4.
That's a great. So the new W-4 that the IRS came out with,
Yeah,
or the
they changed
2020,
it, yeah.
they changed the whole game. Because here's what they are trying to do.
First of all, did they realize did they finally get hip to the game on what people were doing?
Of course they've always known what their people was doing.
For my own education, what were people doing that I'm missing here? Because I haven't seen the new form yet.
You haven't seen it.
No, I have not.
Okay, so the new form, what they have done is it's pretty much just a few boxes. Okay, you either married, single, or head of household, and then you check how many dependents that you're going to be choosing.
Okay.
What they're doing is they're calculating the taxes already for you in advance. Okay, they already doing the taxes because they want to make sure either one. You either break even or they don't. They're not issuing you a heavy refund at the end of the year. So they're doing that for you ahead of time, just based off of the W-4.
Oh, they're doing it for them.
Well, of course they're doing it for them, right? Meaning more on your behalf. Like, hey, check here. Thank you. Now we don't have to pay you a heavy refund at the end of the year.
A little bitty one.
Exactly. Right. So when it comes down to it, here's some strategies that we always teach our clients. This area right here is going to play a major role. As you can see, I guess I can't draw with my left hand.
Yeah, don't use your left.
Right. So right here, the area of adjustments, this is where tax planning comes into play. This is where having a business, a home-based business, comes into play because it play a major role as far as how much deductions that you can make to your income. Right. Also, that area as far as having we talked about traditional IRAs earlier. The adjustment comes into play here because one of the strategies that we can utilize during tax time is you can actually pre-fund your traditional IRA while you're filing your taxes, which actually reduces the adjustments. Because if you fully fund your IRA, let's say $6,000, right? You go ahead and pre-fund your IRA. Say, hey, I'm going to do that in January. Because you have until April 15th to actually make sure the funds is available in the account. You go ahead and do that. You help lower your AGI, which increases your actual refund. So you're utilizing the refund that you're getting to actually fund your traditional IRA ahead of time. So it just takes a little bit of a strategy going ahead thinking about, okay, hey, I have until April 15th to be make sure I open the traditional IRA and fund it. I'm going to go ahead and claim that on my taxes right now and so forth. So having that strategy by going ahead and funding your traditional IRA does help increase the amount of refund that you get, right? So overall, though, when it comes down to taxes 101, this is the basis of everything. So it gives the person an idea of what's happening behind the dollar, what's going on with their taxes, and whether they're going to be receiving a refund or if they're going to be owing.
Yeah.
So during the year, we do a lot of tax strategies, tax planning, and what we do is we go back, we compare the previous year, and then we ask questions such as, okay, are there any major changes that you see that will prevent you or that it's going to increase the amount of income that's coming in this year? So we go ahead and start putting, different strategies. So that way, if we need to go ahead and, fully fund their IRA, we can go ahead and do that as part of their tradition. If we need to have to establish a business as part of the strategy to reduce the amount of taxes that they're going to owe, that's another strategy that we go ahead and put in place right there. If they are too close to their standard deduction and itemizing is going to be the best route, then we go ahead and say, okay, listen, these are the different organizations that you can donate to help increase the amount of deduction that you're going to send in, right? So tax planning is the major key. That's the game changer when it comes down to taxes. And so if there was going to be any advice that I give, our listeners that are paying attention, would be to have a good person on your corner. It's just like boxing. You need to make sure you have the right person on your corner to make sure you win the game, right? So that's where I would say, unless you guys have specific questions that, we need to address, this is a good area to be able to.
Well, I think for most people out there, like you hear tax planning professional, right, which is what you do. Hey, I don't make $250,000, $500,000 a year. Do I really need a tax professional? Can I not use TurboTax? Can I not do it on my own? You know,
Great question. That's really good. What I say is this: if you think it's expensive to hire a professional, wait till an amateur does it. Okay, the IRS love TurboTax. The reason being is because when you type in the numbers, it spits out a refund amount at you. Now, what it's not doing is thinking for you as far as, okay, what other areas you are able to deduct? What strategies can you utilize to lower your tax bill? Okay, because just because you're getting a refund of $1,000 or $2,000 or whatever the case may be, does not mean that you're not paying too much in taxes. Right? Because once again, remember what I mentioned earlier, your taxable income is what determines how much money you're actually paying when it comes to taxes overall. So having and hiring a professional, our number one goal is to reduce your taxable income down to zero as possible.
And I want to talk about that real quickly. As a tax professional, are there fiduciary rights that you are obligated to?
When you say fiduciary right, explain a little bit more.
Like you are working on behalf of your client, not to just get another customer.
Oh, no, listen, I would say the way that we do business, and of course I can speak for us, Aquila Financial and Tax Services, is that we want to represent our clients just as if somebody was representing us. So if somebody was in, if let's say I was in a situation where I needed tax help, right? And I'm sitting down with someone. I want them to do, to work as hard as I would do the same for them. So we take each and every of our clients and we walk them through the whole process just as if we were in their shoes, right? So they, we have credentials all across the state. Okay, so we are not only excluded to the state of Texas. So we can represent clients all across all 50 states, and we do not even have to be the one that prepared the tax return. So if somebody have a tax issues, they've been audited and now they got a tax bill, they can hire our company and we can come in and basically go through the whole process, send different letters to the IRS and explain the scenario and work on reducing the interest and the penalties to be able to lower the bill that they have, right? So
Love it. So hey, James, first of all, thank you so much.
Thank you, sir.
absolutely.
We would be remiss if we didn't give you the opportunity to allow our listeners and our visionaries that are tuning in to connect with you.
Right.
So how can they get a hold of Aquila Financial Tax and Tax Services?
Well, one of the fastest way, of course, you can always reach me on my number, 817-374-5049. The simplest way, you can send me a text. You can give me a call. I'm always going to answer. You can also reach us at the office. We are located in Dallas, 972-348-5525, right? And now another option, you can go to our website and aftaxservices.com, and you can click on contact us. At that point, it will allow you to actually schedule an appointment directly with me, which will send a notification say, hey, so and so wants to set a 30-minute consultation with us, right? So these are different ways that you can get a hold of us. Gives us the opportunity to work with you.
And again, a lot of us have gotten our W-4s at this point.
W-2s?
W-2s at this point, excuse me. And so this is a perfect time for you to get everything in order. Reach out to James one more time with the number and the website.
All right, aftaxservices.com. And you can also reach us at 817-374-5049. That's my personal line. Or you can reach the company directly at 972-348-5525.
Beautiful. Listen, this has been absolutely outstanding. This is the first episode of a series that we are entitling Behind the Dollar. It's important for us to understand what happens behind the dollar, how it actually works, because ultimately we really want everybody to go out here and succeed and be successful, absolutely. Prosperity, and all of that, right? So we're here to help. That's what we're about. Wanted to say thank you, James, for jumping into the lab, man. This has been good. Your drawings are terrible, but the content was fire, brother.
Absolutely.
Your drawings are terrible, but your content is fire. And so, hey, yo, Mo, what are you thinking?
Ladies and gentlemen, he's Ryan Cuffey. My name is Ryan Mosley. Thank you again to James Aquila. You guys have heard the website, you know the name. At this point, the information's out there. Make sure you reach out to him. We appreciate you guys sticking with us. This is our first voyage of Behind the Dollar. We will see you guys in another couple of weeks with another great episode. Stick with us. We're going to give you guys all the game we can when it comes to finances.
Let's do it.